Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. It's a confession, in our view, that you don't really understand the businesses that you own. On a personal portfolio basis, I own 1 stock, but it's a business I know, and it leaves me very comfortable. If I had to bet the next 30 years on the fortunes of my family that would be dependent upon the income from a given group of businesses, I would rather pick 3 businesses from those we own than own a diversified group of 50.
The proper temperament is far more important in successful investing than points of intellect. If you've got a reasonable intellect and the right temperament, you'll get very rich. And if you've got the wrong temperament for it, you'll get done in at some point. And in financial markets, the improbable happens far more often than people think by running statistical regressions and so on. 5 sigma events aren't 5 sigma events. You just have to keep your sanity, basically. If you just always write down on a piece of paper, if you're buying stock in a company, whether it makes widgets or it's an internet company and it has 100 million shares out and selling at 10, you say, I am buying XYZ at $1 billion. You're buying the business because, and then just list down the reasons. If more people did that, you won't have bubbles, but they won't do it. That's why stocks frequently have a high that's twice the low in a given year when everybody knows a business doesn't change in value like that except under unusual circumstances.
Volatility does not measure risk. And the problem is that the people who have written and taught about risk do not know how to measure risk. And the nice thing about beta, which is a measure of volatility, is that it's nice and mathematical and wrong in terms of measuring risk. It's a measure of volatility, but past volatility does not determine the risk of investing. Risk comes from the nature of certain kinds of businesses. It can be risky to be in some businesses just by the simple economics of the type of business you're in, and it comes from not knowing what you're doing. If you understand the economics of the business in which you are engaged, and you know the people with whom you're doing business, and you know the price is sensible, you don't run any real risk.
By far the best investment you can make is in yourself. I mean, for example, communication skills. I tell the students that come that they're going to graduate schools and business, and they're learning all these complicated formulas and all that. If they just learn to communicate better, both in writing and in person, they increase their value at least 50%. If you can't communicate, somebody says, it's like winking at a girl in the dark. Nothing happens, basically. And you have to be able to get forth your ideas. And if you invest in yourself, nobody can take it away from you. If I gave you a car, and it'd be the only car you get in the rest of your life, you take care of it like you can't believe. Any scratch, you'd fix that moment. You read the owner's manual. You keep a garage and do all these things, and you get exactly one mind and one body in this world. And you can't start taking care of it when you're 50. By that time, you'll have rusted out if you haven't done anything. So you should really make sure that you just remember that you just got one mind and body to get through life with and to do the most with it.
It's a temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha, but you do not have to be able to play three-dimensional chess or be in the top leagues in terms of bridge playing or something of the sort. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd, because this is not a business where you take polls. It's a business where you think. And Ben Graham would say that you're not right or wrong because 1,000 people agree with you. And you're not right or wrong because 1,000 people disagree with you. You're right because your facts and your reasoning are right.
I am looking for signals that tell me in investments what height and a few things might tell me if I was a basketball coach. In the end, what I'm going to buy is the business where I feel extremely certain about the competitive advantage, extremely certain about the integrity and ability of the management, and where I think the discounted flow of the cash that business will produce over time makes sense in relation to its current price. You really are looking for a business where you see the future. You want something where price competition is not solely going to be the determining factor. And that's true of razor blades, it's true of Snickers, it's true of See's Candy, it's true of Coca-Cola, and there's a lot of things of which it isn't true. That mode is differentiation of product, differentiation of service, differentiation of location, whatever it may be. And that's essential. So the test of a business is not whether it does something glamorous, something new, it's how much cash it's going to produce over time.
Big opportunities in life have to be seized. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really you gotta grab them when they come. Because you're not going to get 500 great opportunities. You would be better off if when you got out of school here, you got a punch card with 20 punches on it. And every financial decision you made, you used up a punch. You'd get very rich because you'd think through very hard each one. There's a temptation to dabble, particularly during bull markets. In stocks, it's so easy. It's easier now than ever because you can do it online. Just you click it in and maybe it goes up a point and you get excited about that and you buy another one the next day and so on. You can't make any money over time doing that. But if you had a punch card with only 20 punches, you would think a long time before every investment decision. And you would make good ones and you'd make big ones. And you probably wouldn't even use all 20 punches in your lifetime, but you wouldn't need to.
Mr. Market is this partner you have in investing. He's a remarkably obliging partner. This guy comes around every day and he tells you what he'll pay you for your interest in the business or what he'll sell you more at the same price. Nobody ever does that in private business. If you and I owned a gas station together and I said every day I want you to come in and offer me your half interest in the station and I can either buy your half or sell you my half at the same price, and you have to come in every day and do it, you'd be at a terrible disadvantage. And you'd be at a particular disadvantage if you're Mr. Market in the market, because Mr. Market is an alcoholic manic depressive. I mean, he is as unsound as they come. He wanders around all day, and looks at the crazy things, and he's going to name all kinds of crazy prices. And you don't have to pay any attention to him, except when it's to your advantage to do so. The market is there just basically to serve you when you want it to serve you.